Good afternoon and welcome to HYCM's trading workshop with myself, Giles Coughlin. We have got quite a lot to cover this hour, so I'm looking forward to taking you guys through and going through a number of different developments we have in the market, as well as some significant risk events coming up. So just going to say hello to folks as you're coming in. Hi Van, good to have you. Syed, Sammy, welcome. Aaron, good to have you guys. Looking forward to this session. Just going to go through the normal disclaimer as folks are coming in. Hi, Toby. Yeah, good to have you on board. Okay, just to go through again, the whole idea of the trading workshop is that it's a little bit more interactive than the week ahead seminar. And the whole purpose of this is that it's an education. So what this isn't, rather, is it's not trading advice, signal service telling you to take these trades. Instead, it's about how to go about understanding the currency market so that you can make your own trading decisions for yourself. So you begin to understand the factors that influence a currency, and by looking over my shoulder, you start to develop confidence in your own trading ability. The session that we have ahead is a special topic, where and when to take profits. Remember last week we looked at trading fresh sentiment, how to trade sentiment when it's fresh. Well, this week we're going to be looking at where and when to take profits. So that's going to be, a helpful, it's going to be a helpful topic for you. I'm just going to tell you 7 times and places where it kind of makes sense to take profits, and going through some of those obvious places is just gonna be helpful for you, particularly if you're sort of relatively new to trading. There's certain times when and places where you really want to take profits, and the temptation is to try to hold on to profits, to try to get more profits when actually you should be taking them. So we'll be looking at that, and hopefully you guys are going to get something from that as well. Also, one of the members yesterday in the FX Week Ahead said they hadn't been able to get the recording for the How to Trade Fresh Sentiment. So what I'm going to do during this session, I'm just going to go over those slides from last week very briefly, literally just so people can take a screenshot if they like, or so that when this recording is done, people can come back and they can look at the details in their own leisure. But I just thought I'd record that just in case that gets lost. I spoke to support yesterday, and that should all be fine. It should all be, the recording should be coming up, but you know what computers are like, every now and then they don't want to cooperate. So I've just put another batch of those slides up. So we've got another copy as well. But it will be a topic I'll be returning to, because it is so important about how to recognize those sentiment shifts. A real key part of trading comes from recognizing those sentiment shifts and changes. So we will be spending more time in the future looking at those for sure. So don't worry if you missed out, and we will be covering that again. So that's ahead. The handout for the session can be found under the handout section. There's a little, on your GoToWebinar control panel, there is a handout panel. There's a little gray triangle pointing towards handouts 1 of 5. And underneath that handout section, you've got workshop guide September the 16th. And if you click on that workshop guide, you should see this here, this handout. And the whole idea of this handout, you can print it out, keep it by the side of your desk, and it just covers some of the 5 basic kind of pillars of trading for you to look at. So that's what the webinar is based on. We look back, we look forward, we look at the charts, we look at our risk, and we look at the outcome of our trade. This is just a process that has become internalized for me now. I just do this automatically. But until you've got to that, until you've been doing it so often, it's just internalized. Then what you want to do is you want to print this out so that you have a reference to it in the future. So we'll be looking at that during the session. Don't forget, again, if you've got any suggestions for anything you would like covering, email topics to myself, giles.coughlin@hycm.com. I'm always happy to consider new topics, and if that's something you need help with. I know one of the guys yesterday on the FX webinar, Kerrick, hi Kerrick, was interested in trend lines. So that's maybe something we can look at in future weeks as well, you know, how to draw trend lines, how to use trend lines. As you guys know, that I really am a strong believer in fundamental analysis. And, you know, once you have that fundamental analysis under your belt, you're really able to start, you know, understanding the direction of the currency markets. But then you apply your technical analysis to your fundamental analysis. So there is a place for technicals. I'm not against technicals. It's just that the number one thing, particularly for a retail FX trader, is to really grasp the fundamentals of the market. And once you grasp those fundamentals, all of a sudden the technicals end up being more reliable, more consistent, and, you know, a better kind of, you know, a more reliable you know, tool for you as a trader. So that's what we're doing. As you guys know, the heart of what I'm trying to look at each day, each week, is I'm looking to find the strong and the weak currency and looking to trade them against each other. So that's really what the whole, you know, process of looking back. We always want to see what is the current mood of the market and how is it corresponding to you know, what we already know is going on. So we're looking to find strong currency, trade it against the weak currency. The way to think about this is, if you imagine, if you had to, you know, if you had to guess when you saw two people fighting which fighter was going to win, you'd normally guess on the stronger and the bigger fighter, because that would be, you know, just makes sense. And so in a sense, that's what we're trying to do with the currencies. We're trying to find a stronger currency and to pair it with a weaker currency, so that we are anticipating the stronger currency, you know, winning. Okay, and that's essentially what we're doing. If that's, you know, you've just come to this webinar, that's not making sense to you right now, but don't worry, we'll go through some examples, and it should make sense as we go forward. For those of you guys who have been attending for you know, a few weeks and months, that will be fairly intuitive to you by now, that concept you'll grasp. So without further ado, let's turn to our handouts. So the handouts there, we're going to start by looking back. And what we're trying to do by looking back, we're trying to identify the recent sentiment. Now remember, sentiment can be summarized as simply the mood of the market. Okay, the people have moods, the market has moods. And what we're trying to find out is, what mood is the market in? And we want to try to identify the key market sentiment, the major market moods, and then we want to try to summarize that in a sentence or two. So that's what we're trying to do when we look back. And the first thing that I do when I look back each morning, I come to my desk, and one of the first things I want to know is, what were the Asian equity markets doing? I come to my desk just as the Asian equity markets are closing, and I want to see, you know, what the overnight mood has been. So this morning, at the start of the European session, at the end of the Asian session, which is around, you know, 06:30, 07, about 7:30 GMT time, the Asian equity markets, they were broadly lower, following Wall Street's lead on geopolitical uncertainty. We know that the big events that have happened over the weekend, we had the Saudi oil fields attacked by drones. We've had a souring of a relationship between Iran and the US, with the US, President Trump yesterday sort of agreeing that Iran was behind the oil fields attacks on Saudi Arabia. And we have US and China. We have those constant trade wars going on in the background. But they have, risk sentiment has improved recently, but it's just worth being aware of that in the background. So the Asian equity markets were broadly lower. We had the Shanghai composite down, the Hang Seng down full percent. Whenever you see equity markets down a full percent, you want to take notice of that. And the Nikkei was broadly flat. We had some strength in the Australian 200 equity market. So broadly lower, that's the major theme. that we have coming out of the Asian session. So again, I ask a few times, why do FX traders care about the equity markets? You guys should know that. If you want to just type in the answer, let me know in the question panel. Why do FX traders care about the equity markets? Why are we looking at the equity markets? What are we trying to gauge from them? Because they give us a clue, and they give us a clue about some currency's strength or weakness. So just type in the question panel or the chat panel the answers to this question. Why do FX traders care about the equity markets? Yeah, exactly. Kerrick, Sammy, well done. You got it. Adufemi, exactly. That's exactly what we're trying to do. And you see, once you're armed with that piece of information, you are going to be much less likely to make some poor trading decisions. So just understanding that one point. Yeah, Toby, Aaron, Kerrick, exactly. You've got it, guys. Sammy, excellent. So just understanding that one piece of information means that you can prevent yourself from being on the wrong side of the market in quite a few different occasions, okay? So this is what we're trying to look at, is an equity market shows us risk appetite. Remember, equity traders are very sensitive to risk. So as soon as they're concerned, money starts coming out of the equity markets. That's obviously equity markets falling, okay? And you'll see money going from the equity markets into the bond market. There's a school of thought that says you either hold all equities or all bonds. So, you're either got a risk appetite, so you put your money into equities, or you're risk averse, so you put your money into bonds. So when we see money rotating out of equities, we know, okay, the equity traders are feeling risk adverse. They're very sensitive to risk. So that tells us we're in a risk off market. Likewise, on the contrary, if we see a rising equity market, we know that risk is on. Now, so what we saw the US-China trade war evaluation. Very simple for us, wasn't it? We realized that it was going to be a strong risk-off sentiment in the market with the yen and the Swiss franc being strong. So when Sunday evening opened, we were expecting to see risk-off and we were expecting to see US oil markets surge. And that's exactly what we saw. So let's just have a little look at the US oil chart. Just make that a little bit smaller, bring that chart over here. That's it. So let's just get rid of that for a minute. Okay, so here's the US oil chart. So I'll get rid of the pivot points, make it a bit clearer. That was the opening candlestick. Now, obviously, you wouldn't have been able to get in, right down here. I think the market opened in some terminals around 60.50. So it was about a $3 move that was potential for people buying right in on the Sunday evening. Did anyone, just out of interest, did anyone take that trade on oil on Sunday open? If you did, just put it into the market. But if you didn't take the trade, you see the next. You see, this is the thing. This is a good lesson, okay? And this is for those of us who were at the key to trading fresh sentiment. Remember, there's two times to trade sentiment. There's on the news announcement. Now, obviously, the news came out over the weekend, so this was tricky. So I can understand why people didn't necessarily jump in and go long US oil on the Sunday open, because it's a little bit unpredictable, because we've had the market closed and what price is it going to open, how's the price going to respond to that. But going into the weekend, you see oil was selling off, okay? And going into the weekend, I was writing my report for HYCM, and it was clear to me that the outlook for oil was bearish going forward. The International Energy Agency had been, reducing their expected outputs around the globe. There was a number of factors making, it's a very bearish case for oil. But obviously, the lack of supply from the attack on the oil fields meant the supply of oil was potentially going to be restricted. No one knew exactly how much. And so it was an obvious buy on oil. Now, if you missed the first phase, okay, here's a very simple technique for getting the second phase. All you do, you draw a Fibonacci retracement from left. You always draw your Fibonacci's. You draw it from left to right, okay, to the initial spike. And then all you do is you trade the 50% retracement and then back up to the shoulders. So what you could have done here was traded from 58, 59 level back up to 61.20, a dollar 20 increase in price. So once you'd have done that. Now I had an order to try and go long from, I had my fib level here and up to the top here, and I had an order to go long around 58.64. Okay, so I wasn't quite filled, but now for me that sentiment is sort of drawing away. So I'm no longer putting an order in to go long. We've got the Saudi energy minister speaking later tonight at 5:15 GMT, so I might hang around for that, depending if I'm still around at my desk. But that was, for me, that was a trade. So the phase one was the initial spike. Phase two was 50% retracement, which, depending on where you draw your fib level, you may or may not have got, and depending on the execution of your broker, you may or may not have got it. But that's basically the principle that you're looking to doing. Okay, so that's just, was it new news? Was it significant? Yes, it was new. It was significant. Therefore, you get two phases: phase one, the initial spike; phase two, the retracement. Just use a 50% retracement and play back up to the shoulders. Okay, so the shoulder level for me would have been around here, 61.20. Okay, from there back to there, that was the trade. So potentially two trades could have been got by doing that technique. Just leave this intermarket correlation up, guys. Okay, Syed, yeah. Oh, okay. So, see, Syed got phase two, made 130 pips. That's great, Syed. Well done. Very good. I'm really pleased you got that. Excellent move. That's how you do it. That's how you do it. And that's, you have limited drawdown. You're not worried about whether your trade's in profit or you're not going to have to endure a huge drawdown. You've got good fundamental reasons supporting the move, and you've taken your money. So Syed, perfect. Well done. Okay, now here's the intermarket correlation. Just take a screenshot of that. It helps you to know with risk on. So lower volatility index, you'll see stocks rallying, commodities rising, bond prices falling, and that's yields rising. That's risk on. Risk off market, higher volatility index, you see falling stocks, falling commodities, rising bond prices, falling bond yields. That's risk off. And remember, we're interested in a risk on or risk off market because it helps us and gives us a bias of various currencies. And in this instance, it tells us if it's a risk off market, we know that the yen and the Swiss franc will appreciate, and the US dollar. So we saw some US dollars being bid yesterday. We saw the dollar index being bid, and that was on risk off sentiment. Now, the US dollar can be bid at certain times as a safe haven currency. So you just have to remember, sometimes the US dollar will rotate into the yen and the Swiss franc safe haven status. It's not always, but sometimes. And yesterday was a clear time when it did, in that kind of, short, heightened sensitivity. US dollar gains value. We see Australian dollar, New Zealand dollar, and Canadian dollar depreciate in risk-off markets, and I find the Nikkei very helpful. There's a really big correlation between the Nikkei and yen strength or weakness, so Nikkei is always a good benchmark indice for you. Risk-on markets, you get the higher yielding beta currencies like the Australian dollar and New Zealand dollar appreciate, and you get the yen and the Swiss franc sold off. Now, last week, what we saw quite a big risk-on mood, didn't we, for the whole week of last week, and we saw I was sort of posting fairly continuously on Australian dollar, Japanese yen longs, making sense as the Australian dollar was appreciating and the yen was being sold off. So we're going to do a quick experiment now. We're going to have a quick look at equity markets. Let me just see. I'm just going to pull up my other terminal. Yeah, okay, I was going to pull it up. And I'm going to take a quick snapshot of the equity markets, and you're going to tell me what you think is going on. Okay, so I'm just taking a look at the commodity markets and US bond yields. There we go. So looking at these, so here's the commodity markets. We've got the US indices, which, let's have a look, is about to be opening. We've got the European indices, obviously the Asian indices we've already had a look, and we've got bond yields for the US. So having a look at that, guys, what kind of mood is the market in? Have a look and type it in the question panel. Aaron, correct. Saeed, correct. Yeah. Sammy, correct. Well done. Well done, you guys. Yeah, we're in a risk-off mood, aren't we? We can see, look, the European equities are all in the red. So they followed on from the Asian equity markets. So the Asian equity markets have been followed by the European equity markets, and now we're about to be heading in to the US Open. We can see commodities are down. Copper is down. Remember, copper has a strong relationship with the Australian dollar. So when copper's up, that tends to boost the Australian dollar. So copper's down. That's going to be dragging on the Australian dollar. We've got other metals down, aluminium down, iron ore down. We've got crude oil down slightly, but that's just, it's got to pull back from its recent highs. We have got bond yields down. Okay, so when we go to our grid, so what do we got? We got a lower volatility index. It was pretty low. So high volatility index. Volatility was quite flat. Stocks were falling, commodities were falling, bond yields were falling. So risk off. You can see, we're on this side of the panel. We're not on this side of the panel. So we're risk off. So we know straight away, this is how we do our analysis. We know that we are going to be seeing stronger yen, stronger Swiss franc, weak Australian dollar, New Zealand dollar, and Canadian dollar. Okay, that's how we know. Okay, so we've now got the mood of the market. Gold, yes. Now gold, Sammy. Sammy just mentioned about gold. Gold is an interesting one. Now, the thing that the gold's waiting for, Sammy, is waiting for the FOMC meeting tomorrow. Now, gold is a safe haven bid, okay? So what you can see yesterday, you saw the strong bid in gold, Sammy, right? And you can see my fib level drawn here. And this is what I did yesterday. I took a gold long at the 50% retracement of that move, okay, looking again for these highs, okay? And I was entered in around 50% retracement, and it got towards the end of the session. It missed my take profit by like a few, like tiny points. I was trying to take profit up here, up in these, the head and shoulders up here. I was just missed my take profit. I went out for the evening. I just left my pulled my stops down to break even, and I'm either going to get hit, stopped out, or back into a break even trade. I wasn't confident with the risk sentiment away from my desk. So yes, but what gold's waiting for is waiting for the Federal Reserve. And gold's move, unless there's a real bad outbreak, Sammy, unless there's something that was really, Iran and the US declare, US starts dropping bombs on Iran or something like that, then we're going to see gold, be bid on a strong safe haven play. Other than that, I was not sure because I knew I had the FOMC coming out for Wednesday. So that's one to look at for Wednesday. But if you put a gun to my head, what am I expecting? I'm expecting it to be bid. I'm expecting bids on gold as a safe haven play. So that's my take on the gold market. So look back. So what we saw in the Asian session as well in terms of economic data, the usually ignored Australian weekly consumer sentiment data hit a 2-year low. It was 1093 versus 113.3 prior. That got some attention. You can see that this consumer sentiment out of Australia has been falling. Okay, so it's sort of suggesting that the monetary stimulus is not necessarily working. Consumer confidence is down. The trend here is down. Okay. Also, we had the release of the RBA minutes, and we looked at those at the FX week ahead. Weren't necessarily expecting much from it. And what we have got it is that they are sort of mentioning that they are prepared to cut interest rates further in the future. So the minutes taken as a whole meant that there was, an increased chance of rate cuts coming. Okay. In addition to that, we had China's bank backing off a little on their monetary stimulus. They sort of allowed nearly 300 billion yuan in money market instruments to mature today, but they were only rolling over about 2/3 of that amount. In other words, they just pulled back from some of their easing. Remember, a boost for China is a boost for Australia, okay? And the yuan was weakened, but the China stock markets dropped also as well. So a little bit of a backtrack for China overnight. We saw the RBA saying, interest rate cuts are more likely to be coming. Australian weekly consumer sentiment. So you put that all together, and it's very clear that we're expecting Australian dollar weakness. Okay, so that was the sentiment coming to my desk this morning. Very, very clearly looking at Australian dollar weakness as a key market sentiment, a key market mood. We had UK PM Johnson. He had a fruitless journey to Luxembourg yesterday. There was some sort of fairly embarrassing situation where he was speaking with a Luxembourg representative, and Boris Johnson couldn't actually make the lectern, and it all turned into a bit of a farce. So that was a poor result for PM Johnson. Yen lost a little of its safe haven status on the news that the US-Japan have agreed tentative trade deal terms. This headline came out overnight as well. Okay, so there's a little bit of a boost for the risk-on sentiment, although risk-off sentiment was still primarily there. But the news that US and Japan have agreed tentative trade terms would be a boost to risk appetite. Okay. So looking into the Asian session, coming to my desk, I was looking at the Australian dollar Swiss franc for a potential short. And let's just have a little look at that chart. So this is when we look at the chart. So let's have a So looking here, you can see that a good place to short this currency pair for me is around these current levels. I will be potentially looking at shorting, and stops above 0.6850, and then looking to play back down to this 0.6738. So that's what I'm looking for. Again, this is not trading advice. This is just explaining that I'm expecting sellers from here, stops, breaks on stops above here, and looking to playing down towards these lows, or even further 6738. Obviously, if risk sentiment really, really drops off badly, we're just seeing a little bit of support from these 0.6800 level here. So a little bit of a crossroads here on the pair, but fundamentally expecting the Australian dollar to remain pressured. I'm expecting the Swiss franc to remain bid. The things that would alter this view is if you get some really positive global risk news, something that's really good, that's going to boost the Australian dollar and is going to weaken the Swiss franc. So any positive global risk sentiment news would boost that. So potentially, if the Saudi energy minister is really optimistic and says, we can get everything back up and running in no time at all, that potentially could switch us back into a slight risk, on status. So that's the risk that I see for today. Otherwise, I'm expecting sellers from these levels, and you can see that 1, 2, 3 touches on this descending trend line. So that makes a sensible place for me, where I see shorts entering on that kind of trade. Going to the European session, we had the September ZEW survey. That came down at minus 19.9 versus 15 expected. You can see that's one of the lowest readings in about 9 years. So a very bleak picture for the Eurozone, not a surprise. The economic sentiment picked up a little to minus 22.5 versus minus 37 expected, but the outlook is still very negative. So that was another negative reading for Europe. Also, there's some reports that if oil prices remain elevated due to supply constraints, that's going to drag on the European economy, because the European economy will be dragged down by higher oil prices. So that's just to be aware of that, double whammy. High oil prices will make the European situation difficult. I remember where the ECB are at the moment, they did cut interest rates, they did announce a fairly open-ended quantitative easing program, but what they've said is that there's only so much that monetary stimulus can do, and they've really been saying that we need fiscal stimulus from the government to really support the euro. So just to be aware of that dynamic, the ECB are kind of stepping back a little bit, almost handing the ball over to the European government. So that's just something to be aware of. Now, if the European government don't step in, they don't give fiscal stimulus, then things are just going to get worse for the euro. But that's just more than we've got time to look at for now. Oil traders, Saudi oil minister speaking at 5:15 GMT. Now, the key thing to watch for this is how long will it take for the oil fields and the oil infrastructure to get back fully operational. That's the question. The longer it takes to get the fields operating, the more bids we're going to likely to see in oil. Okay, so if the Saudi oil minister comes up and says, okay, it's not as bad as we thought, we should be able to get things running by the end of the week, then I'd expect a retreat in oil prices. If he says, this is much worse than we initially thought, it's going to be months and months before oil production gets back up to prior to the attack levels, then we're expected to see oil bid. So that's the risk for the Saudi oil minister speaking at 5:15. So that's just something to be aware of. And again, if you're trading the Canadian dollar, then you want to be aware of that as well. Okay, because if you're trading Canadian dollar, remember oil impacts the Canadian dollar. So don't forget that basic correlation. Well, we know that the UK PM Johnson is set to unveil his plan next week to EU leaders on the sidelines of the UN General Assembly. So Johnson's got a plan for the Northern Irish backstop. He's got a way of trying to solve that backstop problem. If that gets accepted, we can expect to see the pound bid. So I'm expecting potentially some bids in the pound in the run-up to this meeting next week, but we'll see, because from a technical perspective, the pound is really quite highly bid. Okay, you know, it's gone from 1.200 pound US dollar pair to 1.25. I'll just show you that on the chart, and you'll see what I mean. And it's just. Right, see, so the pound has been bid up here, 1.200 up to 1.25. That's a big move. And now we've hit, look, we've hit that 100 exponential moving average. So we are up against some fairly stiff resistance there. So, you know, will it go much further? Potentially, yeah, I could see it potentially going up further, but there'll have to be more, you know, detailed signs of some kind of, you know, warmth about PM Johnson's plan. So that's just one to watch coming up. Also, we got a Supreme Court judgment on the legality of PM Johnson's suspension of Parliament. So the Supreme Court is the highest court in the UK. The highest court used to be the House of Lords, and it was replaced by the Supreme Court. Now, this is all to do with PM Johnson when he prorogued Parliament. So he suspended Parliament from here to here, which is nothing unusual. It's not like an unusual mechanism that Boris Johnson used. It's just that the timing of it was, you know, in one sense, you could argue it couldn't be better for Johnson. It couldn't be worse for everyone else. So the whole Supreme Court is about, was it legal what he did? Has he done the right thing legally in calling this prorogation of Parliament when he did? If the Supreme Court rules against him, then that means Parliament gets back to meeting again. So you can see what Johnson's been able to do. Look, our current Brexit leave date is the 31st of October. So by blocking out all this time, what PM Johnson was hoping to do was hoping to prevent other MPs, you know, blocking a no-deal Brexit, making it difficult for him. Now, in the end, Johnson has to officially go back to the EU and ask for an extension. But there's no guarantee the extension will be granted. And also, will Boris Johnson actually do it? So there is a lot of risk around the pound at the moment, and it is very hard to stay on top of what's the next, agenda. So the key to thing is anything that makes it look like a deal is going to be done will be pound positive. Anything that makes it look like a deal is less likely to be done will be pound negative. So that's the sentiment going into it. But watch out for this, the Supreme Court judgment. That will have an impact. If Johnson is found to be illegal, then he will probably have to call Parliament back, and we'll have a bid in the pound, and we'll have more shenanigans out of the UK Parliament. Sentiment for the US session, again, I was thinking weak Australian dollar, strong Swiss franc. The other currency pair you could use is Japanese yen. So if we just go back to this currency pair, let's look at the Australian dollar, Japanese yen. So there we can see, just see that break of that descending trend line. Got a pivot point there. Pivot point there. So in terms of what we could do here, you could see like potentially, a short from current prices with stops above the 100 exponential moving average would potentially be a good value entry, but that is kind of on the basis that things get worse with the risk sentiment. Okay, otherwise, any refilling up of that gap. So anything back up to here, 7420, 7430 region would potentially be another place to enter short. 7420, 7430, stops above recent highs, 7450, 60, with profit taking down here, 7390 would potentially make sense on the Australian dollar Japanese yen pair. So here we go at the importance of fresh and changing sentiment. I'm just going to quickly go through these. So these sides, we went through this last week, and I know that I know there was a gentleman who wanted this repeated. I'm just going to put it up here for you to take screenshots to going over it. And I asked support about the recording of last week's, and it should be, I'm just seeing a report here. Okay, Saudi oil input will return to normal levels quicker than initially assumed. Two sources report. Top Saudi source says Saudi output will be back online fully in next 2 to 3 weeks. So let's just see how the oil chart is reacting to that. Let's see. See, there we go. We're getting an instant response there. And we're seeing this selling off here. Okay, that was the headline to look for. How quickly will oil sources get back? So we're seeing a shift now. That is an important shift, and yeah, that is an obvious. If you were there for the time, that was a first phase oil short. Okay. And depending on the news, we'll have to look at it later, have to weigh it up, but that potentially could be a 50% retrace and move back down. Because obviously if they get oil supply back up a couple of 2-3 weeks, it's not gonna matter so much. You might get a little bounce here off that 50% level, but with that kind of headline, the move is clearly going to be down. So that's just okay. I just saw that come across the feed. Look at it later, and okay, just take a quick screenshot of that. And just let you guys take a screenshot of that. Give you a second. And that. And that. And that one. That one. That one. So that one. That one. But that's just that one and that one. Okay, the thing that we've seen has been really helpful is that was a really good example. We were looking at that just now, weren't we? So let's not let's not just lose the lesson. That's really helpful. And that's likely to be positive for risk sentiment as well. Yeah, okay. And we're seeing the CAD obviously is being affected by oil prices as well. That's what we expect. So, you know, you need to identify what is the significant, what is going to be a trigger for a sentiment shift. And you see the trigger that we identified was, you know, how quickly will oil levels return to normal, right? And this headline here was just out saying that they should return back online fully in the next 2 to 3 weeks, because there had been some reports saying it's going to take months. So, you know, we've seen oil fall from 62 down to 59.40 odd, just below 59.40. So that's a big move. That's your phase one move, and let's get rid of that. So that's the shift. You know, that is the sentiment shift. Now, obviously, you got to watch out for conflicting headlines. Okay, we've also got to remember that the Saudi energy minister is speaking later today at 5:15. So there's other headline risk events, but you get the idea. When you're focused in on what's going to be the issue, and we were saying just earlier, you know, that's going to be the issue, and there we see the headline. So that also tells us we're focusing in on the right kind of, you know, we're on the right issue when we're doing that kind of thing. Okay. So look, you know, a risk that we've got coming up, a sentiment shift to watch for the week ahead, is obviously the FOMC meeting. We've got the Fed expected to cut interest rates by 25 basis points this week, and alterations to that outlook will provide opportunities. So if there's no rate cut tomorrow, that's obviously going to be US dollar strength. We expect US dollar buyers at market. If there's a rate cut but dot plot shows no more cuts expected, expect mild US dollar strength. And if we get a 50 basis point rate cut, then expect US dollar weakness. Okay, so 50 basis point rate cut, and we expect US dollar weakness. That would obviously be a surprise. And if we got US dollar weakness, that's when we'd see the gold market really take off, Sammy. So that would be a real strong, you know, buy. You'd see a lot of buyers coming into gold on a 50 basis points rate cut. So now we've got our special topic, where and when to take profits. Now, this is a good, you know, this is a good lesson for us to learn, where and when to take profits. The first place to take profits is support and resistance. Take profits at key levels. Now, I'll show you an example here. Okay, let's just look at the pound CAD chart. Any chart will do. I'll show you where we want to end up taking profits. Here's a daily chart. Okay. Whenever you're getting into key support and resistance levels, you just want to be taking profits. So, for example, here you can see, look, this is a key overhead resistance level. So if you were long pound CAD from any of these levels, as soon as you were coming into this level, you just wanted to take profit. Now, the temptation is to think that you're going to crash through these levels and keep going on and on and on. The market doesn't move in a straight line. Look, you can see, even though it's gone from here up to 1.7700, it's gone in a very kind of zigzag fashion. Okay, that's typical of market behavior. Market behavior moves in these zigzags. You know, look, this is, you know, for months and months, it's zigzagging. So when you get into key support levels, take profit. Key overhead resistance, take profit. Don't make the mistake that beginner traders make of not booking their profit. As soon as you're into a decent level, just take your profit and take it off the table and go and look for the next opportunity. Next place, average daily range. Right, your average daily range is a tool that you see on your MetaTrader 4 account. Okay, so go to your MT4 account, open up your indicators, and open up the average daily range. Now see what the average daily range is on the currency pair for the day. And then if you're trading intraday, take profits at about 40 to 60% of the average daily range for the day. Okay, so if you're trading, let's just say you're trading pound yen, and the average daily range is 120 points, for example, you want to be taking your profits around something like 45, 60 points. Okay, if you're trading intraday. So intraday traders, you come to your desk and you're looking to open and close your trades within the day. Okay, you're looking for 40 to 60% of the average daily range. The other time to take profits is prior to major news events. So if you're in a trade, you know that there's some major data points coming out. So the big GDP data, interest rate statement, retail sales. So you've got some top tier data coming out, and you're in profit. Just take your profits. You might be tempted to move your trade to break even. Now, only move your trade to break even if you've got around 70 to 100 points profit on the table. But otherwise, if you move your trade to break even prior to a major news event, price is going to be whipsawed around, the spread is going to increase, so the chances are that you're going to get taken out with the volatility around the event. So unless you've got significant profit, you want to be taking profit prior to major news events, or else you're just going to end up, if you got to 10, 15 points profit and you think, well, I'll just move my stop to break even, then you're almost certainly just going to get hit out of break even, and the profit you had is gone. So prior to major news events, take profit. As well, of course, the major news event can go against you and all your hard-earned profits can just suddenly disappear. Before weekends, take profits before the market closes. Now, this is a key issue, really. Think about the weekend. The picture for oil before the weekend was very bearish. Okay, so some people might have been tempted to either initiate a short trade on Friday or hold a short oil trade over the weekend, and then obviously get some unexpected news on the weekend and the whole market shifts. So that's the thing to remember, is take profits before the market closes. Okay, you can always open your position again on the Sunday. You don't want to be leaving your profits over the weekend as a general rule. Okay, if you've got a couple of hundred points in profit, fine. But other than that, you're going to leave yourself open to weekend risk. And it was only, I think it was last month when Donald Trump, introduced extra tariffs on China over the weekend when the market was closed. So the last thing you want to be, imagine if this last week you were risk on and you held your risk on trade over the weekend, and then imagine something, Donald Trump had announced extra tariffs over the weekend, and you would be, have a position a long way against you. So key thing here, take your profits for weekends. You can always open them again on the Monday. Okay, and you may get a better price. But generally speaking, take profits on the weekend rather than holding that unnecessary weekend risk. London fix. Now with the London fix, this is a time 4 o'clock GMT. Now, not everyone obviously who's involved in FX are trading FX because of their traders or hedge funds. A lot of the interactions that happen in FX are just for regular businesses, companies who are paying their employees, buying goods, shifting currencies from one arm of the company to another. And so at the London fix, a lot of these regular client transactions are made, 4 o'clock GMT time. So just be aware of price movements around the London fix, okay? Just to be aware of them. You get these price movements, and all of a sudden, you know, you might see something shoot into a support or resistance level. You might suddenly see a quick jump, 30, 40 points. That's a good time to just take profit. Okay, this London fix can be a funny time. You can often get the fix faded. There's a dark arts element of this here as well. Say, you know, you're a big firm and you know that, you know, you've got some big companies are making some big orders. You can take advantage of those price movements, knowing which way price is going to go before you place the order, and then take advantage after you place the order. So just to be aware of that little dynamic that takes place around the London fix. And finally, a good time to take profits is around the end of FX sessions. So this makes sense, doesn't it? You know, when Asian traders are finished trading, a lot of the intraday traders, they'll book their profits. So you'll see a retrace suddenly with the European session mid-morning. You'll often see profits that are made mid-morning, then retrace around lunchtime as London traders go out for their lunch. And then at the end of the day, the US session, 10 o'clock GMT time, you see the the markets really die down and then get going again, that couple of hours time with the start of the Asian sessions. So guys, that is these are the free resources to work out sentiment by yourself. We've looked at the charts as we've gone along. What trades, this is a new feature we're doing. What trades are you looking at? So are there any trades that you guys are looking at here that you want to pop into your question panel and let me know? What? Any trades that you guys want us to go through? Let's have a look. Dollar yen, EFAM. Okay, let's have a little look at dollar yen. So EFAM, what's your thinking on dollar yen? What are you looking for? What's your rationale for a dollar yen trade? Obviously, you've got the FOMC coming up. Risk off. Okay, I see what you're saying. The problem with dollar yen is that the dollar can also operate as a risk haven. Okay, so Olifemi risk. Okay, Olifemi, your risk off. I've got it. Okay. Okay, right. Because here's the dollar yen chart. Yeah, you're right. There is some dollar demand into the FOMC. You can see it gap down, but the dollar demand took over. Remember that the dollar does operate as a risk currency as well, so you can see it being bid. There was also the US-Japan trade deal that was completed. The trade terms were kind of agreed as well, so that's supportive of dollar yen. So yeah, that makes sense to me. Although for me now, you're going into the FOMC tomorrow, so I wouldn't want to initiate any positions now, and I'd be looking for a potential trade out of the FOMC EFAM. So that's what I'll be looking at now. And obviously we're looking if the US didn't cut interest rates, obviously we see the dollar yen, rally on strongly. So if it was a risk-on environment, I'd favour a dollar yen. If it was a risk-off environment in that situation, then a New Zealand US dollar short would make sense for me. Olifemi, yeah, risk-off sentiment. Let's have a look. A good pair for risk-off trading is the Australian dollar Japanese yen pair. Okay. Now, the Australian dollar Japanese yen pair is a good pair for trading because it's very sensitive to risk. So, I can see risk off sentiment, Australian dollar, Japanese yen pair would make sense, like an Australian dollar, Japanese yen short. I could see that being a decent potential risk off trade. Obviously, we've just got that news out about the supply should be able to get back up to standard in a couple of weeks, so that's going to be positive for risk on. So that's one, you've got to look at risk sentiment now, as it potentially is at a crossroads. Okay, and that hence you've seen the spike back over the 100 exponential moving average. Okay, so you see it's price resisted, broke, resisted, and has now broken through. So that's just something to develop. But broadly, yeah, Olive Feigning on a risk-off sentiment, Australian dollar, Japanese cents would make sense, especially with the news of a potential rate cut coming from the Australian central bank, RBA. Okay, guys, thank you very much. It's been a great hour with you all. Thank you for putting so many different questions. Okay, yeah, if you're looking at the European session, okay, so there's a question from Aaron. He's just saying, when assessing mood, I've looked back at the Nikkei and Hang Seng during the Asian session. What would you suggest are the best European markets to check for the European session's mood? Thanks. I'd like the DAX is very good, the FTSE 100, and the French CAC 40. So those major European indices. So DAX is obviously the biggest European contributor, individual country that contributes to Europe as a whole. So DAX has got to be up there. And the UK obviously is one of the biggest economies in Europe as well. So FTSE 100, DAX, France is big as well, the CAC 40. And then halfway through the European session, we obviously get the US session coming on. And so then you're looking at the S&P 500 and S&P 500 futures and the Dow futures. So that's what I'd be looking at, Aaron. Okay, great, guys. Thanks a lot. It's been really good being with you all. Yeah, no worries, Aaron. You guys have a great week, and I look forward to seeing you next Monday for the FX week ahead, 12:30 GMT. Okay, guys, I hope you have a good event. Don't forget the big event out tomorrow is the FOMC, main scheduled event of the week. So that's one to have a look at and look back through this webinar if you want some tips on the extremes reactions we might get if the Fed deviate from their base case. Okay, guys, take care now. Bye.